All right, chapter 12 is going to be a little bit different. You're on your own here to go through this lecture material, review the PowerPoint slides, and really be responsible for learning this particular material on your own outside of class due to a couple of canceled classes this semester. So I need to make sure we get this material covered. It's really important information. And so, feel free to watch this at your convenience, at your speed, in spots, pause, take notes, however you best absorb this information. It is going to be tested just like any other chapter, and so I want to make sure that we spend some time going through it, and I share some of my thoughts and the most important aspects of valuing preferred stock. And so in chapter 11, we looked at valuing common stock. In chapter 12, we're going to dive into how we look at preferred stock. And then in the following chapter, in chapter 13, we look at valuing bonds. Right, so preferred stock is a unique type of investment. And I often describe it as a hybrid between stocks and bonds. And it sits really here in the middle, in between what a common stock is and a bond. And some of the features of preferred stock are very similar or the same as common stock, and some of the features are the same as debt or bonds. Right? So here's how preferred stock kind of is similar and then also differs from common stock. Preferred stock, in its name, or preferred shares, have preferential treatment. So you'll sometimes hear them referred to as preference shares. They are often sold or offered up in early stages of a company, and preferred stock gives investors the first claim. They are essentially, in terms of equity, the first ones in line. Okay, they're the first in line for dividends. They're the first in line in the case of a liquidation. They're first in line in terms of extra kind of payouts and things of that nature. Often, preferred stocks have a convertible feature, and we'll look at that conversion feature here in a few slides. But they have the ability to be converted to common shares after a specific period in time. Again, this is very common when we're talking about new companies, companies that are in their startup kind of phase or high growth early on. They tend to have a fixed, steady dividend that is not dependent on earnings. It's a fixed dividend. It stays the same for the life of the preferred share. It does not fluctuate, and so therefore it's typically not dependent on dividends, or earnings. Now, preferred shares do not have any voting rights. So if you own a preferred stock, a share in a particular company, you have no ability to vote. You can't make your voice heard when it comes to the board of directors or any sort of direction inside of the company. Preferred shares may or may not have any of these variety of features, and each of these features or components makes the desirability of the preferred shares differ. And so because the desirability differs, the risk associated with preferred shares differs based on these features. And so the required return that investors receive or expect to receive differs based on the features that are included with the preferred stock. And so the first is the idea of cumulative dividends. Now, preferred shares are not required to pay a dividend. However, they're required to pay a dividend prior to common shareholders receiving a dividend. Okay. Now, again, the dividend is fixed. It's the same every year. Cumulative dividend feature says that let's say our Teva preferred shares that pay $1 a year dividend did not pay any dividends last year. Okay. Under a cumulative dividend, they would require to pay last year's dividends and this year's dividend, so $1 for last year, $1 for this year, so $2 total before they could pay any common share dividends. And so it's kind of like a catch-up feature. They have to go back and pay out all of the ones that they skipped before they can pay common shares, right? So this obviously reduces the risk to a preferred shareholder, but then the dividends may be a little bit lower. There is sometimes a call provision, which allows the firm to buy back the shares, just like a call provision on a bond. The preferred shares may have a call provision, which allows the company to come back and buy back the shares after a given period of time. Now, preferred stock dividends are non-tax deductible to the firm. The company cannot tax deduct them. However, dividends received for a business are tax deductible. So you'll often, kind of interestingly, see companies own preferred shares of other companies because the dividends that they receive from owning preferred shares from another company are tax deductible within some sort of limit. So that makes preferred shares a little bit unique. You don't often see companies owning other companies' common stock, but we do see them owning other companies' preferred stock on a much more regular basis because of that tax benefit or the features that come from that tax side of things. So the first kind of discussion that we're going to have in terms of preferred stock is the idea of vanilla shares. When I say vanilla preferred shares, basically meaning there are no kind of additional features, nothing that makes this preferred stock issue unique in any way. It's boring, vanilla. Vanilla preferred shares have no voting rights. They have a fixed dividend that's paid, let's say annually or on a regularly scheduled occurrence. There's no conversion option, and we're talking about selling them only to individual investors. We're not looking at the tax benefits of corporate investors. Okay, because of that, the valuation is very similar to bonds. All we're really analyzing is the present value of all of the future cash flows, right? The preferred stock pays a dividend each year. And so we're looking at, okay, the price of the stock, P of 0, is equal to the dividend, which stays the same. You notice that D doesn't have any sort of subscript. The dividend is the same every time period, and we're just discounting it based on our required rate of return. Okay, so we can simplify our formula by the price of the preferred stock is equal to its dividend divided by our required rate of return. So if we're looking at a vanilla preferred share that pays $4 dividend, and our required return as an investor is 8%, how much would we be willing to pay for one share of that preferred stock? All right, well, we simply look at it as $4 divided by 8%, and we get a valuation of $50 per share. Here's another example here. If I paid $50 and I received the dividend, and then I sold it in 1 year because the valuation went up to $57.14. Okay, what would be my rate of return? All right, my rate of return here would be 22.29%, right? Because I got my dividend and the price that I sold it for minus the price that I paid. All right, now let's look at the second type of preferred shares. These are convertible preferred shares, meaning they can be converted into common shares at a set date or after a very specific period of time. Let's say after 5 years, they can be converted to a number of shares of common stock. Okay, the conversion ratio is the number of common shares that I receive for one preferred share, right? And because of kind of arbitrage, the conversion price needs to kind of equal the conversion ratio. And I'll explain this a little bit further, but if I could, let's say the conversion ratio is 5. So for every 1 share of preferred stock, I get 5 common shares. And the price of a preferred share is $25, and the price of a common share is $6. Well, if I converted my preferred stock, I would get 5 common shares. 5 times $6 is 30. Or I could have one preferred stock for 25. Well, obviously I'd want to convert it and make $5 there on the difference. All right, so the conversion price is the price that the common stock should be based on what the preferred stock is and its conversion ratio. Right, so if I own a share of preferred stock that's selling for $50 and the conversion ratio is 6.5, what should the conversion price of a common stock share be? Right, well, if the price of the common stock, or excuse me, in this example, then if 50 divided by 6.5 is equal to 7.69, $7.69. So if the price of the common stock goes above $7.69, the preferred shareholders would consider selling their shares, right? They could sell, convert their shares. They could convert it and then immediately sell their common stock, and we would have an arbitrage situation, right? At least in the short term, right? They'd be able to make some additional money because the conversion ratio would be kind of out of whack a little bit. Now they give up the ability to be a preferred shareholder. That comes with the benefits of a kind of a fixed long-term dividend, and so there may be, a decision not to do that, or even if it's kind of out of that equilibrium, they may still want to hold on to their preferred share. So how do we value convertible preferred shares? Right. Well, the value of convertible preferred shares is the price of the preferred share without the conversion feature plus the value of the option to convert the shares. Okay, the value of the option, we'll discuss that later on here in the chapter. Right. So the price of the convertible is equal to the, essentially the price of a non-convertible preferred share plus whatever that value of that conversion option is. That option comes with its own kind of set value to it. So let's look at this question. Atlantic Company offers convertible preferred stock for $120 per share with a conversion price of $6.25. What is the conversion ratio? I'll give you a little bit of time here to see if you can figure out what that conversion ratio is. All right, let's see if we got it. Answer here, 120 divided by 6.25 equals 19.2. So for every 1 share of preferred stock, we should then receive 19.2 shares of common stock, right? Assuming the pricing and the conversion ratio are holding in line. All right, so let's look at, again, kind of valuing non-cumulative preferred shares, right? So I talked about cumulative preferred shares. Non-cumulative is another way that the dividends are paid out. With non-cumulative shares, the dividends can be skipped, and does not need to be repaid in the future, right? Um, if preferred shares don't pay that dividend, common shares do not either, right? So there is that component of it. Valuation is the same here as dividends that are made regularly, but we should use a higher discount rate to reflect the increased risk, right? So in this example, if we went back, we had $4 a share with a required return of 8% for a cumulative. Well, there's higher risk here because they could skip the payments and we don't necessarily get to go back and capture those payments, right? So the only thing that we're adjusting here is our discount rate. Again, non-cumulative preferred shares, more risky than cumulative preferred shares. So our valuation drops from $50 a share to $44.44, right? To reflect that higher level of risk that comes from it. So our formula does not change. You just need to kind of know, hey, cumulative preferred shares have less risk than non-cumulative preferred shares. So let's look at an example here. What would the yield, right? What would the return be here of a preferred stock that was purchased for $38.50, and it provides an annual dividend of $2.07. All right, see if you can calculate what the dividend yield would be here on this particular preferred stock. I'll give you 30 seconds or so here to solve this particular question. All right, let's see if we got this one figured out. $2.07 divided by 38.50, we get 5.38% dividend yield for this preferred stock. All right, the next category here is participating preferred shares, right? Participating is the keyword here. Participating preferred shares get the regular dividend, the fixed regular dividend that pays, let's say, every year, and then may have additional dividends depending on predetermined conditions. Let's say that they hit a profitability number. Think of this as like a profitability bonus if you're working for a company. If we hit a certain threshold of profit, we're going to pay out an extra bonus. Well, the same would hold true here with a participating preferred share. So example, let's say that the dividend to preferred shares must be at least equal to that of the common shareholders. So let's say the preferred dividend is $1 and common shareholders receive $1.05. Well, the participating preferred shares are going to receive an extra 5 cents per share. There's something that's going to be kind of tacked on. Maybe the company wants to pay out larger dividends to its common stockholders, but the participating preferred shares have a condition in their share agreement that requires that they receive the same as the common shareholders. So we would have this participation or this additional dividend that's paid. Okay, extra dividends are hard to predict, right? And so we're going to continue to use the fixed regular dividend, but because there's some additional kind of upside, we're going to lower our discount rate, our required rate of return. Participating preferred stocks carry a little bit lower risk because of that potential kind of additional upside and that trade-off that comes in here. And so back to kind of the same formula, $4 divided by our new discount rate of 6%. So in this example, our participating preferred shares pay $66.67. So participating preferred stock is valued, $16.67 higher than the non-participating preferred stock of the same company. Okay, and then important to kind of understand is the after-tax return and the tax implications. Individual owners of preferred stock pay taxes on the dividends that they receive, right? They're taxed just like regular dividends. No tax preferential treatment. There's nothing about preferred shares from a tax perspective that benefits individual owners. Now, corporations do receive some benefits. Okay, the dividend received deduction in the U.S. tax code reduces corporate taxes on dividends received from other corporations. So there's an incentive for corporations to own preferred stocks. Startups use these shares to raise capital, especially if they're being spun off from large corporations. And so this preferential tax treatment for preferred stock through the DRD incentivizes companies to invest in these startup or spin-off companies in order to have them have access to capital.